So what does this mean? And you're going to see interest rates go down.
Hello and welcome back to Change and the Market, your weekly look at the changing real estate market. I'm your host, Brian, joined as always by our resident market expert, Chris Masiello. Good morning, Chris. How are you doing today?
Morning, Brian. Good to be with you and be with our community.
Awesome.
On a snowy New England day, you know.
Yeah, we were talking before we started here. You guys got dumped on up there. We have a nice sunny day here. It's cold, but we don't have 40 inches of snow or whatever you guys got up there.
Well, it's a lot.
Obviously, the big news of the day is Silicon Valley Bank. That's kind of top of mind for everybody. You were on a call yesterday, so you have some insight. Let's go ahead and hear what you have to say about SVB.
Yeah, so thanks. So, yeah, I was actually on another quickly organized private investor call with Goldman Sachs yesterday about Silicon Valley Bank, SVB. And this is probably going to be a little bit of a geeking out on financial data, but I think it's worth it. And I'll try to keep it, I'll keep the strokes broad.
Yeah.
Silicon Valley Bank was kind of the investment bank, for Silicon Valley, right? A lot of like high tech and innovation. They also had a fairly significant portfolio in things like crypto and alternative currencies. And recently, with interest rates going up, the stock market has actually declined about 20% with the cost of borrowing money going up. So this is about over the last year, and that reduced the bank's liquidity. In this particular, this case, the banking system's liquidity, but in this case, SVB, it reduced their liquidity, and of course, crypto's had its own issues. And so the value of that part of their portfolio has gone down, and then the overall stock value has gone down. And when we talk about the Federal Reserve raising interest rates, when they raise rates, what they're doing is that they're raising the cost that the banks pay to borrow money. They're not directly raising it on like your car loan or your house loan or your credit cards. They're basically raising it on the cost of borrowing the money. And of course, then the lender does pass it off to the consumer. And in essence, what it's done is it at some level will affect profitability of the bank or banks. And so in this particular case, interest rates go up, stock market goes down, crypto has its own kind of decline in value, and the bank needed to raise about $12 billion and couldn't do it. And then the FDIC stepped in and basically said that we're going to take the bank over. We'll make all the deposits good, which they don't have to do. They only have to insure up to $250,000. But the Federal Reserve came in, and the FDIC came in and said they would make good all depositors' funds, which was, I think the right thing to do. But also, I think it steadied and calmed the markets. Stock market's gone down a little bit, but generally speaking, I think this was good. And I don't think this broadcasts a broader, banking crisis like what we saw in 2008. I think this one in particular has got the influences of cryptocurrency and things like that.
Yeah, absolutely. So kind of jumping off of that and kind of boiling it down for what does that mean for people in real estate, in the industry? What can they expect moving forward, kind of coming off of this?
Well, first, what I would say is that I've given you a very broad schematic of this, right? And if you're interested in it, I would really encourage people, you go to Yahoo Finance or any of those places, and you can learn about it. It's worth following. I think kind of the long and the short is that the Federal Reserve has been under a lot of scrutiny for their target inflation rate of 2%. And, when you take a look at, like, inflation is roughly 6%-ish, something like that right now. It had peaked at like 8 or 9. And so I think what you kind of get out of this is that the reason why the Federal Reserve has been under so much scrutiny with this really low inflation target is because we just finished the pandemic. There's a ground war in Europe, and basically the entire globe is flush with cash, because of the stimulus packages that each country's reserve bank, central bank, had designed for their particular country to help them, get through the pandemic. And so you take those three factors and you're like, really? Like a 2% inflation? Like that doesn't make any sense. You have supply chain disruption, you have energy disruption with what's going on in Europe, with getting away from Russian energy supplies, and I think that skepticism about this 2% inflation target has really come home to roost. So what does this mean? And you're going to see interest rates go down. You might get one. They're going to meet next week. You might get one more small rate increase, or they might hold. But I think at the end of the day, they're going to have to reduce rates, the rate that the Federal Reserve charges the banks, okay, which then gets passed on to the consumer. But they're going to have to reduce, I think, those rates to increase the liquidity in the banking system, okay, increasing the profitability for the banks. And I think that's what we're going to see.
Interesting, very interesting. So your prognostication is interest rates taking a slight downturn here soon is kind of
they could be quite a bit. I mean, one of the forecasts I saw on my call yesterday was a full point, 100 basis points.
Wow.
Yeah, when they say basis points, a basis point is equal to like 1% or 1 point. So you say 100 basis points, that's equal to like 1 full percent.
Well, getting into our final topic, as always, what general advice, life advice do you have for people this week?
Yeah, well, you never know when the next shoe is going to drop, but you're almost guaranteed one's going to drop. So,
Very true.
It's always about you never know what the unexpected is because it's unexpected. Okay. Well, the one thing though that we can always be guaranteed of, always, no matter how quiet it might seem, is that there's always something unexpected that's going to happen. And although we might be a little surprised at what the event itself is, we should really never be surprised that there's some of that. And because this kind of came out of nowhere. And then I think the silver lining in it is that in this particular case, I think it highlighted I think a poor interest rate policy from the Federal Reserve. The depositors are going to be covered. It'll probably help lower interest rates, and so you never really know exactly what the unintended consequences are of these surprise events. But I think this one could turn out really, really well for everybody with the lower cost of borrowing. So.
Interesting. So yeah, expect the unexpected is always
expect the unexpected.
Always good advice, I think. It's a good way to kind of go into the world. You'll never be surprised.
Yeah, I mean, my phone was like my phone was blowing up with all these alerts from Goldman Sachs, and I'm like, what is this? And then I went on it and I was like, really? Silicon Valley Bank? So
yeah. Wow. Well, that's going to do it for this week's episode of Change and the Market. Fantastic advice as always from Chris. If you're enjoying our show, make sure you like, subscribe, or follow us on whatever platform you're watching or listening to us. And join us back here next week for another brand new episode of Change and the Market.
Thanks, Brian. Good to be with everybody.